Hello and welcome to this video. In this video, I'm going to show how to do risk and return calculations in R, but this time for a whole portfolio of stocks. For this video, I planned the following. First of all, of course, we have to define the portfolio weights. So with which weight does a single stock contribute to the portfolio? Then we're going to calculate portfolio returns. We're going to calculate a covariance matrix. And of course, we're going to calculate the weighted portfolio risk. Now we switch to R and I will show how that works out. Okay, just arrived in R. I have prepared a little before the recording of this video. Of course, I have given the whole code a beautiful headline, risk and return analysis, and I now add portfolio, of course. And then, just like in other videos, I already did all the data gathering. So we will need the library QuantMod. If this one is not installed on your computer, you can use the install packages command and hand over the parameter QuantMod. I don't have to do this here because this package is already installed on my computer. But of course I have to run this library using the library command. Then, as I always do, I define a new environment that is called env.stock with the new.env, or new environment command. I run this, and then I run the usual get symbols command to load the 30 stocks that are the DAX 30 blue chips into our environment. So this will take a few seconds. That was it. And now I extract from this environment. I just show you, in this environment now we have all the DAX 30 stocks. And now we extract from this environment all 30 adjusted close price time series. How do we do that? With the add command, we can get a single one. We use the eApply command to grab or to apply the add command to all 30 given in the environment. So to all 30 XTS objects in the environment stock. That will end up in 30 XTS objects that we have to merge, and since we have to run this merge command 30 times, we use do call and we save that into XTS adjusted. And here's our XTS adjusted, and we see all the stock prices here. Okay, now we have to calculate the log returns, the daily log returns in this case. How do we do that? We log, of course, all the data. Then we take the differences with a lag of 1 day and we apply the NA omit to get rid of the NAs. And that was it. And we can have a look at it. No, log returns. I'm sorry. Log returns. Here they are, and we see here Adidas. And this day, Adidas from 2nd January to 3rd January 2017, it dropped by 1.3%. And Volkswagen increased by 1.9%. And so on and so forth. Well, these are daily returns. Then we have to convert them into annual returns. The most easy step how to do it is first to calculate the mean returns. So I'm going to define a vector mean returns and use the asApply, and the asApply will apply the function mean to all objects in the XTS and return a vector. So here's our vector of mean returns. They are very small because it is still a daily return. And now we have to convert them into annual returns, which just means multiplying it by 250, and since it is log returns, we take an exponent and subtract 1. So let's run this, and we can have a look at it. And here are our annual returns. So for Adidas, we see 19% increase, Volkswagen 4% increase, BMW 6% decrease, and so on and so forth. Okay, and that's it. So now we start combining a portfolio. And the first thing that we need is to define the portfolio weights. And of course I do this as a vector that I call weights. And I use the very most simple weighing scheme. So I need a vector of 30 values because we have 30 stocks. And I just repeat or replicate 1 divided by 30, so 1/30th. And I do this for each of the 30. And I'll just run this. Let's have a look at this vector. And there it is. It is a vector of 30 values, all of them 1/30th. So this is an equally weighted portfolio. It's not necessarily the case that we need to combine them equally weighted. We can adjust this vector however we like. We can do a market weights. So take the market capitalization or whatever we like. We just need to take care that the weights add up to 1. That's important. So I'm going to write that down. However we weigh, the weights have to add up to 1. That is important, otherwise our portfolio would be quite curious. All right, now we have to calculate the portfolio return. And that's the reason why I already prepared the annual returns, because since we have the annual returns of all the stocks, we just need to weigh them with the weights vector. And this is what I'm going to do. So I just write a variable here. And it is P returns. So for portfolio returns. And now we are weighing. So we take the cross product of the weighs vector and the vector of annual returns. And we run this and take a look at it. And here's our portfolio returns. So in the time between 2017 and 2020, mid-2020, we would have earned 4.6% if we would have equally weighed all the DAX 30 stocks in our portfolio. By the way, the cross product, of course, is simply a matrix multiplication. We would have achieved the same if we would have taken the transposed vector of weights and matrix multiplied this by the vector of annual returns. So let's have a look at that. And again, we achieve the same result. All right, now that was easy, wasn't it? Now we come to more complex calculations. We're going to calculate the covariance matrix. So the covariance matrix is typically written VCOV. So we just take this abbreviation here, and the cov command will give the covariance here. So if we just run this one, we will get something like, let's have a look at that. Like this. So we will get very, very, very small, tiny numbers. Even here on the, where we see the variances, why, so the variances are typically on the main diagonal here. Why are these so small? Because they are on a daily basis. So if we want to have them on a yearly basis, we have to multiply by 250 again. Again, 250, that's the number of trading days normally at the German Stock Exchange. So if we do that and take a look, we get a lot higher numbers, and that's correct here. So, now we need to weigh the portfolio risk. So, calculate portfolio risk. And how do we do that? Again, we need a variable for the portfolio variance. And now we multiply the vector the vector of ways, sorry, times the matrix, the covariance matrix, and again times again the vector of weights, but we have to transpose it, and we would get an error if we don't use the matrix command here. So vector of weights. Okay, let's have a look at that. Now we want to have a portfolio volatility. And let's have a look at that. And there's our portfolio volatility. Wonderful. So I hope this you liked this video. Thank you for listening, and see you in the next video.